Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, November 15th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. David, how are you doing today?
I'm doing good, Will. Thank you.
All right. Let's start off with look what the market's been doing this past week with a look at the market letter.
Okay. All right. We had a very volatile week last week. A lot of stuff going on. We had the midterm elections coming out, and then on Thursday we had a CPI report that actually showed a little break in inflation. So the market went up about on the Dow about 757 points on Monday and Tuesday, and then just before the when the election results came in, we had about 1,000. We had about a 700-point drop, so nearly erased everything from Monday and Tuesday. And then we got the first kind of a crack or slowdown in inflation numbers. Core-CPI, which is ex-food and energy, was only up 0.3%. I think it was expected to be up 0.4, 0.5. And that was 7.7% year over year versus 7.9% expected. Now, that's not a big change, but it is the first change we've seen in the CPI in quite a while. So we did see yields move lower, and equities took off. And once they took off, they really took off. And we were up about 1,200 points, I think, on the Dow. The NASDAQ was up 7.35%. A lot of buying in growth stocks. Of course, when rates are going higher and we're starting to see inflation, that usually will that keeps a cap on growth stocks and technology stocks, which are growth stocks. And once we see that crack in the inflation and maybe what's going to lead to a possible slowdown in the rate hikes, that's good for tech stocks and it's good for growth stocks, and that's what we started to see last week. And we're seeing a little bit of a carryover of that as the week's getting started here. In fact, CME Group FedWatch, which I talk about quite a bit, projected about an 80% probability now of only a 50-point or a half point hike in December at the FOMC meeting, and that was up from about 60% mid-October. So that continues to move down. We also saw, as far as that goes, I think we're down now to, let me pull this up real quick here. Yeah, we're still looking at about an 80% odds of a half a point hike on that. So that's good for just the fact that we're slowing down. It's going to allow the economy and investors to see that perhaps you got to let these rate hikes work their way into the economy a little bit. It's not just something that's go up 3/4 that'll slow things down. So we'll see how that goes over the next couple of weeks. As far as volatility goes, we also saw a kind of a mini crash in cryptocurrencies. That happened after FTX.com. It's kind of a crypto exchange with their own native token. They kind of went off the tracks, and there was a trading firm called Alameda that their balance sheet was ruined from that. They called off a buyout after they looked into the internals and saw what a mess that company was. So that carried over across the Bitcoin. We saw Bitcoin coming down here below 17,000. I think it's about a 2-year low on that also. A lot of people, it's kind of stepping on the sidelines here, and I think that's probably something you want to watch play out here a little bit before you would jump in on that. We also saw some volatility in Chinese stocks. They're starting to ease some of their COVID restrictions. That's sending materials higher, some of the commodity stocks higher. And we had the China Internet ETF, KWEB. It was up about 6.5% last week. Although it's still down about 50%. So I do think there's some opportunities in the China market. I would something like that I would probably nibble on at best, as long as you see our market starting to move up a little bit too. As far as the sectors go, We did see gains in materials, REITs, financials, and consumer discretionary. They outperformed. The tech sector itself was up 10.04% last week. That was the best it's been since April 2020. We also had communication services, which is XLC. It was up 9.4%. That was on strength in Google and Meta, Netflix, which is up about 30% just over the last month. That's a big part of that. What else is in there? So Alphabet, Netflix, Meta, a couple others of that. But that's why those stocks really performed so strong last week. And again, a 10% move in technology is amazing. Actually, the semiconductors were up. I think they were up about 9-10% also. I don't have that right in front of me, but we'll get to that later on. So anyway, at the end of the period, we did see the Dow had about 1,300 points. It was up 4%. The S&P 500 was up 5.9%. NASDAQ jumped 8.1%. And the small caps they lagged a little bit. They're only up 4.6%. So after all that, we had, as far as the technical condition of the markets go, they improved. Obviously, we saw a lot of the major averages once again pushed up through the key moving average resistance areas we talked about a little bit. They've been kind of going back and forth on those things. And those moving averages are watched by algorithms and traders. When they cross back above, you can usually get a little bit more of a bounce on that. As far as the technical indicators went, they all moved back up into bullish territory. MACD shows the short-term trend gauge is bullish. Momentum, which we talked a lot about last week with the 14-day RSI, is firmly in positive ground. And we also saw a lot of the different indexes get above that 65 number on the 14-day RSI, which we spent a lot of time last week talking about that as far as a change or a signal that the downtrend is probably over with that. Okay, we also, which we're going to look at a little bit later, but maybe is we're starting to see some downward sloping trend lines get broken to the upside, which is big. You just like to see these former resistance and support areas hold and break. Also, long-term trend lines that the more a stock or an index touches a trend line, the stronger it is, and when it gets broken, it's a big signal that the sentiment has changed and you're either more bullish or bearish. In this case, more bulls are coming on board. We also saw some positive divergence in some of the secondary indexes. The Dow Jones Transportation Index and the small cap Russell 2000 crossed above their respective 200-day moving average, and they also finally cleared their October highs. Now that's important in the fact that on the way down, we basically had lower highs and lower lows continuously, and now for the first time we're starting to have on this rally. We're actually taking out the October highs, and we have several indexes today approaching the August highs, which would be a big plus for the market going forward. Now, I did say something about the Philadelphia Semiconductor Index. It also crossed back above its 50 and 100-day moving average. And every sector was positive last week. But we did have several that, you want to see this also, that crossed above their 200-day moving average. In this case, we had the financials, XLF, healthcare, XLV, industrials, XLI, materials, XLB. They're all trading above their 200-day moving average. These are sectors that if you're wading back into the market here, these are the sectors that you want to be buying with a little bit more. And I know you want to go back into some of the technology stocks, some of the big caps, but I think you also want to open your eyes a little bit to see some of these other sectors that have underperformed over the last year or so. We also we saw a little bit of selling in the defensive sectors, and by that I mean the utilities, consumer staples, and healthcare. They were the only groups actually that gained less than 2% last week. So even though they lagged a little bit, they're still strong. And I think just a little bit of a safety trade, but people still aren't sure what's going to go on here in the fourth quarter with earnings and stuff. You want to have a if you want to be pretty broad-based, you don't want to be overweighted in any real one sector. And then, of course, we have the energy sector, which has been making new highs, all-time highs. That's still an area that you want to keep some exposure to. As far as underlying breadth goes, that was bullish. We had the advanced decline lines on both the NYSE and the NASDAQ, which we consider leading indicators of the market direction, showed broad accumulation. They moved up nicely. We also had the New York on the NYSE. They posted more new 52-week highs twice last week. They did it yesterday, and they're doing it again today. And the NASDAQ, I'd have to go back and check, is close today of having more new highs and lows. It's right now we're at 100 to 108, so it's close. That hasn't happened in I can't tell you, but the last time we had 2 or 3 days on the NYSE with more new highs and lows was sometime back in April. So that's always something good too. And we also had a little bit as far as sentiment goes. It was kind of mixed. We had the University of Michigan Consumer Sentiment Index fell to 54.7 last week, and that was down from 59.9 in October. The AAII, which is the Retail Investors, American Association of Individual Investors, it fell to about 25.1% bullish. That's way under the historical norm. There's also just a small tick lower in the hedge funds and all. The National Association of Active Asset Managers Exposure Index eased down to 54.6 from 55.2. So the professionals are still about 50-50 as far as their exposure to equities. You'll probably see them maybe add a little bit more this week. And then finally, the percentage of bullish and bearish investment advisors is about even. The same amount of number of bulls and bears. So, it's still when you see this much bearishness in the market, it's usually an indication that you're close to a bottom, and it may be time. I think that we can probably start to add to some of our positions. We changed over to a bullish posture on the market back in let me see, went bullish. I think just back sometime in around in October. So we're up a couple thousand points from there already, and like I say, we had the momentum index moved up a little bit last week. We are starting to get some signs that some of these indexes are getting overbought. Some of the stochastic readings are getting up around in the 90s. We also saw, I believe, 73.2% of stocks are above their 50-day moving average. Anytime that gets above 70, it's a little bit of a red flag. It just means that you've had a big move, that a little bit, maybe probably too fast, too quick. So that's nothing I'm really worried about. I think that will probably continue to go. But we also saw some of the major indexes or averages start to turn up. So you now have a rising 50-day, a rising 100-day, I believe, and that's also a sign that the intermediate and short-term trend is up. As far as we go this week, again, we're seeing a lot more volatility in the markets. Yesterday, let's see what happened yesterday. We worked a little bit higher. It was kind of a higher early, then we kind of sold off in the afternoon. I think investors were a little bit cautious going into this morning's PPI report, and then we had another break in inflation numbers. As far as the PPI goes, that's the Producer Price Index. We saw that slow down to only 2.2% month over month. They were looking for a 0.4% rise on that. And then as far as the core PPI, which is minus food and energy, that was flat versus 0.3% estimated. And then year over year, the PPI was up 6.7% versus 7.2%. Again, that got everybody excited. We saw the NASDAQ jump up almost 2% this morning. Again, that's strengthened the big cap technology and growth sectors. Also helping some of the growth stocks was earnings today from Walmart, Target, and Home Depot. They all came out and beat earnings. That pretty much tells us that right now the consumer remains in pretty good shape as we head into the year end. We're going to have all the Black Friday sales and all the Christmas shopping coming on. The fact that some of the big box stores are already, had a great third quarter bodes well for those companies going forward. Amazon was a little bit weaker, I think, yesterday. Part of that was just because they laid off a bunch of employees. Same with Meta. Meta traded up on that. But some good economic news today. We were up about 300 or 400 points in the Dow Jones, and then before we came on board here, there were some apparent missiles that landed in Poland, whether by mistake probably, but it did cross a line there and took the Dow Jones from up about 300 some points to was down about 100 something, and we're back up 88 right now. I think they're going to probably dabble with this tonight on all the news shows. We'll see what happens, but that certainly could throw a wrench in things here over the near term.
All right, so it looks like we should see the major averages nudge higher here. You set targets in last week's market letter for the different indexes. Are those end of year targets or levels you see the market going to over the near term?
Well, they can go over the near term. We've talked a little bit. We've now gone into a seasonally strong period, and historically after the midterm elections, the market kind of that takes away. Whenever you have stuff that the market just can't figure out. It doesn't like uncertainty in the market, and the fact that we now have the midterm elections behind us, that's a big plus. The nice seasonality time comes in, and I think that just the fact that we were so oversold on the broader markets that we can probably have a pretty nice rally here going into the end of the year. Now for the Dow, the near term target was about 34.2. Go ahead and go to the charts for a second, Will. And in fact, we can look at the Dow Jones because there are a couple of things that's going on that we're taking a look at. Okay. Going back here, looking at about a year. If you go back here to this January, you can go up there and click on the trend line. You can draw a pretty nice trend line from up there all the way down through, and you can see that this last week we broke above that trend line, and that's a pretty big deal. So we hit up there once, twice, three times. Now this is the fourth time we've come up to that trend line, and we've broken above it this time. That's a good sign for the market going forward. Dow, and the fact now that we're approaching this the August highs on the Dow will be another good sign. If we can get above that, then from there I think we can probably, let's get my numbers over here. If we get to this 34.2 target, we're at 33,560 right now. The market's coming back down here with these news headlines. But if we can get above that August high, then I think the next possible target for us to look at would be about 35.5, which would mark the April high. I'm not sure we're going to get to that, but I am pretty certain that we should be able to see 34.2 on that. Go ahead and pull the S&P up. Okay, and this is another one. You can also draw a nice trend line in on this. And as you can see, we're getting right. The S&P got up to this trend line today and bumped into it. So it's also up here bumping up against the 200-day moving average. So the S&P is just struggling just a hair in here. I said that my target for the S&P 500 was 4,100 to 4,150. I still think we should be able to see that. Breaking above the 200-day moving average at 40.76, I believe, is we need to see that first, and then I would target the 4,100, 4,150 in there. You possibly could get up to a measured target of 41.70 on that. The August high is 43.25. I'm not sure we'll get up to that before year end, but I do think we can see this 41.50, maybe even 41.70 on that. While we have this up, we'll now go to UUP. Okay, this is a little comparison, and what you see here, and this is when you're at home, if you take a look, the UUP is the dollar ETF, the U.S. dollar. And as you're starting to see rates come down here, we broke below 4% on the 10-year last year. I think we've gotten up to about 4.3. That's a big move in there. The downside of the 10-year going down is that it's back inverted with the 3-month, which is has a pretty good track record of calling a recession down the road, which probably still indicates that we're probably going to go into one here. But as the rates pulled back, you started to see on this comparison graph, when the dollar's coming down, it's good for the market, and you're going to see the S&P move higher. So as long as the rates stay down, you start seeing weakness in the U.S. dollar. I think that would be an indication that we could see this the S&P 500 especially get up to that 4150. Go ahead and go to the NASDAQ. And this one, not to compare, just for the regular NASDAQ. Okay, this one here it's kind of struggling to get above some key moving averages. It was more oversold than the broader market, but as we're going along here, okay, the NASDAQ today and today's rally got right up to the 100-day moving average, and it kind of bumped into that. It's kind of stalled. We still had the 14-day RSI is below 60 on that. Despite this big bounce off of from last week, off of 10.3, something like that, we've come up almost 1,000 points. But we need to break through that 100-day moving average on the NASDAQ, and if we can, then I can see upside here around 11.9 to 11.950. And actually, if they can get through that, the 200-day moving average would be about 12.2. And I think it should probably get, if we have a nice run into the end of the year, it could possibly get to that. I wouldn't be disappointed if it gets up, doesn't quite make it up to that. I think, like I say, around 12 or 11.9, 11.950 was our target on that. And that's kind of where I think we may kind of struggle at that point. We don't need to go to the rest of them, but I will say that I did want to mention that if you saw Will draw that trend line on the Dow Jones and the S&P 500 from their old highs, you can also do that with the Dow Jones Transportation Index and the Philadelphia Semiconductor Index. And you can do that at home. If you go back there, you could draw it from the high and then walk it down. Especially on this one here, if it's from the transports, you can move it on down through there. You can see that it's in the process of breaking above a descending trend line too, and that's as they do that, it's just a bullish sign for the broader market. You want to see leadership in these secondary markets, and that's again positive divergence that probably means that we'll probably see more of the more highs in the market here. I do think, like I said, this uncertainty today with these missiles going off in Poland, I don't think it should lead to something that big, but it will probably lead to the volatility over the short term. But if we can get around that, then I think we're probably in pretty good shape to the end of the year. One of the things that we do want to mention, we reset for A, B, C, and D cycles to this low off of the October low. There's still some questions about whether the D cycle bottomed there or not. If it didn't, then we might see some more weakness coming onto the market in January. But we'll have to play that by ear as we start to see other divergences and stuff going on. But so right now, I do think we can probably see a little bit more of a bounce. We'll get some more numbers coming in here the first week of December after the holidays. As far as if we get another month of slower inflation growth, or maybe even a little bit of a crack, again that should push us up to the end of the year, and we should be able to hit these targets by that time.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer in the next Tuesday Tech Talk, email it at support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.